This LOS is explain and evaluate how leasing, rather than purchasing assets, affects financial statements and ratios. Okay, we've seen this slide before, but before we jump into this LOS on leases, just wanted to point out again some IFRS references. Leases falls under IAS International Accounting Standard 17. So recall we've looked at plant, property, and equipment. That's IAS 16 is the relevant standard. IAS 28, investments and associates, we're not covering in this reading. IAS 38 is intangible assets, which we look at. And IAS 40 is investment property, which is LOS that we look at in this reading as well. So that was just another quick summary of the international accounting standards with regards to long-term assets. Now we're going to be looking at leases, which falls under IAS International Accounting Standard 17. Leasing. A lease is a contract between the owner of an asset, the lessor, and a party seeking use of the assets, the lessee. Through the lease, the lessor grants the right to use the asset to the lessee. In exchange for the right to use the asset, the lessee makes periodic lease payments to the lessor. A lease, then, is a form of financing to the lessee provided by the lessor that enables the lessee to purchase the use of the leased asset. The lease versus buy decision. There are several advantages to leasing an asset compared to purchasing it. Leases can provide less costly finance, usually require little, if any, down payment, and are often at fixed interest rates. The negotiated lease contract may contain less restrictive provisions than other forms of borrowing. A lease that is structured to provide a company with the tax benefits of ownership while not requiring the asset to be reflected on the company's financial statements is known as a synthetic lease. Leasing, we'll look at some key terms. A lease is an agreement whereby the lessor conveys to the lessee, in return for payment, the right to use an asset for an agreed period of time. A finance lease is a lease that transfers substantially all the risks and rewards of ownership of an asset. Title need not necessarily be eventually transferred. An operating lease is a lease that is not a finance lease. Minimum lease payments, the payments over the lease term that are required to be made. For a lessee, this includes any amounts guaranteed to be paid. For a lessor, this includes any residual value guaranteed to the lessor. A lease is classified as a finance lease if it transfers substantially all the risks and rewards of ownership to the lessee. If it does not, then it is an operating lease. When classifying a lease, it is important to recognize the substance of the agreement and not just its legal form. So it's substance over form. Situations that individually or in combination would usually lead to a lease being a finance lease include 1. Transfer of ownership to the lessee by the end of the lease term. 2. The lessee has the option to purchase the asset at a price that is expected to be lower than its fair value, such that the option is likely to be exercised. 3. The lease term is for a major part of the economic life of the asset, even if the title to the asset is not transferred. 4. The present value of the minimum lease payments is equal to substantially all of the fair value of the asset. Or 5. The lease assets are of a specialized nature such that only the lessee can use them without significant modification. So a quick little graphic with regards to finance lease versus operating lease. So when we look at the lease agreement, we have to determine substance over form, whether it's a finance lease or an operating lease. So the first thing we look at is there a transfer of ownership? If yes, then it's a finance lease. Is there a bargain purchase option? If yes, then it's a finance lease. Is the lease term for the major part of the economic life, like 9 out of 10 years? Yes, then it's a finance lease. Is the present value of the payments substantially all of the fair value? If yes, it's a finance lease. If the answer is no to all those questions, then it's not a finance lease and we have an operating lease. So now we're going to look at some of the differences with regards to the balance sheet and income statement and some of the ratios between a finance lease and an operating lease. So when you have a finance lease, the lessee is going to take the asset onto their books. So assets equals liabilities plus equity. If you have the asset on your books, your asset is going up and your liability is going up, okay? So your assets are higher under a finance lease versus an operating lease where they're lower. So as I said, if your assets going up, your liabilities are going up, so your liabilities have to be higher, okay? And then if when I have the asset on my books, the way to look at it, it's pretty easy to understand, in fact. It's like the lessor is giving me a loan to purchase, okay? So I have interest expense for example, because I've borrowed money, and I have the asset and I have a depreciation expense. So I have interest and depreciation, okay? So that means my net income in the early years is lower than an operating lease. And the reason is because the depreciation and interest expense in the early years is greater than the operating payments. But what happens with a loan over time? With a loan over time, the interest rate decreases, okay? The interest expense decreases over time. So in later years, the depreciation and interest is less than the operating payments. So in the early years, the net income on a finance lease is lower, but it crosses over and it's higher in the later years. The total net income over the life is the same. It's just a timing issue, okay? Cash flow from operations is higher under a finance lease, lower under an operating lease, because with a finance lease, the payment is split between principal payment and interest payment, where in operating lease, 100% of the payment is cash flow from operations, okay? So we're going to have a lower cash flow from operations with an operating lease, which I think is easy to understand. It's 100% like a rent payment, okay? The cash flow from financing, though, is going to be lower with a finance lease and higher for a operating lease for the exact same reason. But the total cash flow is going to be the same. So again, that's just a classification issue. So again, in summary, the way to think of a finance lease is that as the lessee, I need to take the asset onto my books. So assets equals liabilities plus equity. If I have the asset on my books, my asset's going up, my liability is going up, okay? And I'm being financed. I'm making annual payments for 5 years, 10 years. So those payments, just like a mortgage or a car payment, have got an interest component. I'm paying back principal, I'm paying back interest. The total amount of the payments is going to be more than the initial value of the asset, okay? Because I'm paying interest. So in the early years, I have depreciation expense and I have interest expense, okay? And that's going to be greater than an operating payment, which is just like a rent. But interest comes down, interest expense comes down as the loan is ground down. So in the later years, I'm going to have a higher net income versus a operating lease, okay? So it takes a little bit of work at the beginning to understand the leases, but at the end of the day, it's not that hard. Just think a finance lease, I've got the asset, A goes up, L goes up. Oh, I've got the asset and I'm borrowing money to get it, so I've got depreciation and interest. That's more than a rental expense. So moving on now to look at some of the ratios for the lessee, and these are from the lessee's point of view. I've got the asset on my books equals liabilities plus equity. So as I've said, my asset's gone up and my liability's gone up. So you can see, always look at your numerator and denominator, what's happening. My asset turnover is going to be lower because my assets are higher, okay, under a finance lease. So under an operating lease, my asset turnover is going to be higher. Return on assets, okay, as I've mentioned before, and I'll mention again, as goes the net income, so goes the ROA and ROE. So in the early years, as I said, you've got that interest and depreciation expense, which makes my expenses higher than an operating straight out rent in the early years. So my net income is lower. That means my return on assets is lower in the early years. Similarly, my ROE is going to be lower, okay, in the early years. My debt to assets is going to be higher. Why? Look at my debt. My liabilities has gone up. Even though my assets and my liabilities have gone up, my debt to assets is going to be higher under a finance lease. And my debt to equity is going to be higher as well because I've got the higher debt. So again, down here, I've just a little bit reminder. Assets equals liabilities plus equity. Finance lease, increase A, increase L. Early years, the finance lease, the net income is less than the operating lease, so the numerator is a smaller percentage. Denominator, big for ROA. Lower net income is lower ROA, lower ROE. And that's the last slide for this LOS. Thank you.